we look as the largest tech private equity firm. We almost have a fiduciary duty to look at every large tech deal. And what happens when we look at things around the fringes of enterprise software, it gives us more conviction in enterprise software, because we notice more and more the resiliency in some of the issues that you're discussing today. Resiliency in a recession, ability to increase prices in a highly inflationary environment. So now, the price of Twitter at $44 billion looks a lot like the enterprise software deals that we do, from a revenue multiple standpoint, from a growth standpoint, from an operational improvement standpoint. But once again, that is not our core business. That is something that is perfect for Elon Musk to do. So what does one do in these situations? Once again, it depends on the specifics. Now, when you sign a merger agreement, in general, now I'm talking in general, it is very, very difficult to get out of that merger agreement. You have a signed contract, and calling material adverse effects, for example, in general, is almost unheard of. It's almost impossible to do. These contracts are really, really tight.
Just on that, can I ask you, we've obviously seen a repricing going on across the market in technology, and Steve was just talking about how in Hong Kong we're seeing that tech index off more than 4% at the moment. So we understand as monetary conditions tighten here, we're getting a reset on tech valuations. At Thoma Bravo, how are you then rethinking the way you are structuring deals? What B plan does this trigger you to go to when it comes to adjusting the terms of any relationship you're going to do?
It's very interesting. The tech industry, and software in particular, is being repriced mainly because the industry has an operating problem. That is the real issue, much more than interest rates, much more than inflation, and much more than a potential slowdown. When you look at software as part of tech, most of the companies that are publicly traded in software are unprofitable. The average publicly traded SaaS software company loses money, negative 5% EBITDA margin. So we've now gotten to the place of enough industry maturity where investors, given all these headwinds that they now see, are saying, I want profitability today. And that is going through a major re-rating. I'm going to talk about two worlds real quick for you. For example, you take the few software companies that are profitable that are publicly traded. You consider that the profitable index. Those companies are down from a peak of 25 times EBITDA to 18 times EBITDA, much more in line with the declines in the market in general. Now, when you look at the unprofitable index, which is most of it, it's gone from 17 times forward revenue to 5 times forward revenue. Investors are trying to figure out, what is this worth? And what have I just bought? Now, in terms of structuring deals, to your question, we have been doing this for 22 years. We started doing software in the dot-com bubble burst, when there were some similarities in terms of valuations and in terms of how you buy companies. We buy companies at a revenue multiple. We borrow a small amount, usually 25% of the purchase price only, on those revenues, and then we create the earnings through operational improvements. That's part of what private equity does. Is there a change in how we structure deals? Absolutely not. The debt is still there, especially from the private markets, but these deals are mostly about the equity. What has changed is now you're looking at lower comps and potentially lower pricing in these buyouts.
Orlando, very briefly for me then, is this going to change anytime soon? I would slightly disagree with you about saying that now investors want profit now. I think they just want to see a route to profitability that apparently they weren't asking about previously at the peak of the market. Are we at the trough of the market, and actually is the industry that's left going to be profitable?
Sorry, there were people talking. Say that again.
Well, let me just ask you one basic question. Are we at the trough of the market in terms of valuation now, or is there way more pain to come for companies that still can't exhibit a profitable route to market, or a route to a profitable proposition?
Yeah, I think there's more pain to come. I do. Because when those companies really start getting down to answering the investor question that you mentioned, the path to profitability, they're not going to love what they see. That requires a lot of cost reductions, it requires a lot of pain, and it's difficult to execute, especially in a public setting. Now, that route to profitability that you may disagree with, investors have been trying to back into an EBITDA multiple in 4 years, assuming a 25% to 30% margin. That has been going on for forever in the software industry. The main issue is that 4 years later, the companies give you another 4-year plan to get there. And now investors...
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.